And it's 1:30 p.m. right here in Lagos, Nigeria. Time to bring you some market analysis and insights in Business Incorporated live from Channels HQ. Here's what's coming up on the program. The National Monetary Fund forecasts growth of 3.0% in 2023 for the global economy, well below the historical average of 3.8%. Egypt's inflation quickens to a record 38.0% in September. Plus, Kenyans set to get direct access to $47 billion Nigeria bonds. Hello, welcome to the program. I'm Ladi Williams. First off, let's kick off with the markets now with a stop at major markets on the African continent. We see the NGX there marginally up there, 0.01%. Not a convincing move up at intraday. So depends on how this goes. It might swing anywhere at the end of close. In South Africa, the GSE there was down big yesterday at intraday, but we're seeing a recovery, 2.04% at intraday. Other markets we track in North Africa, we see the EGX 30 also doing pretty well, 1.66% at intraday, and the Kenya bourse there, 93.60. That's the all-share index, and it's up 0.12% to close. That was yesterday. Let's look at what's happening in the Middle East. Now, see, it's mixed sentiments right there. In the UAE, it's mostly negative sentiment with the Abu Dhabi index down 0.17%. Dubai index, 4,051 points. That's down 0.12%. But on the flip side, it's positive sentiment in Saudi Arabia, 0.60%. And the Qatari index also up 0.16% at intraday. And it's the final day of AFSIC 2023. Focus this year is on making finance work for Africa's future. FSD Africa is a big part of this year's event. Let's talk to Mary Njuguna, Principal Specialist, Capital Markets, FSD Africa, joining me right there from London. Great to have you on the show.
Thank you, Ladi. Thanks for having me.
Right, so it's day two, final day of AFSIC. What are the challenges you've seen with respect to unlocking financing for Africa?
Thanks, Ladi. Allow me first to introduce FSD Africa. So we are a specialist development agency. We are funded by UK Aid, and we exist, just as you said, to make finance work for Africa's sustainable futures. We work across three broad thematic areas. One is capital markets, risk and resilience or insurance sector, and also leveraging on the digital innovations on the continent. And through these three avenues, being able to support development of sustainable growth within the region. So just directly in response to your question, allow me first to say that for us, we see opportunities and risks, or opportunities and challenges as the same side of the coin. And so if I can mention some of the challenges, just looking at the broader issues, the macroeconomic factors, some of the challenges are high public debt that is increasingly unsustainable because of the global economic headwinds. We see inflationary pressure, high interest rate environment, and currency volatility. That makes it more expensive to raise capital. But if we move further down and look at the markets themselves, we know that different markets are at different stages of development. Some markets are only starting to crawl, others are starting to walk, others are starting to run. And therefore, we see different kinds of challenges. One is the enabling environment. In some markets, the policy and regulatory environment is not as robust as others. And we know that it's important to have a very strong regulatory environment to provide legal certainty, investor protection. Another thing is that I look at capital, or the flow of capital, like the flow of a river. It has to flow to be able to water certain parts of the real economy to enable them to grow and to flourish. And so if it doesn't flow properly, maybe because of capital controls or other hindrances in, for example, the exchange of securities between buyers and sellers on an exchange, then that makes it difficult for capital to flow. The other thing is the availability of pools of capital. And when we are talking about pools of capital, we're talking about institutional capital, pension funds, banks. How deep are their pools of capital so that they can be available when buyers want to buy or sell? And also the depth of expertise of market intermediaries. That's very important because market intermediaries have the role to create innovative solutions and to interface between buyers and sellers of capital.
All right, talk to me about countries now in Africa. Like, I know a lot of countries are there to receive funding and also a lot of businesses from different countries. Talk to me about which countries in Africa you see attracting more investments and help us value, investment commitments made so far.
That's a good question, and data is a good way to answer that question. As we know, there are many instruments that are used for channeling investments into Africa. And allow me to use two data sets to answer that question. One, when you look at the kind of bonds that are being raised in the region for green and social impact objectives, we see that they've increased over time. And so when you look at the flow of that kind of capital to see where it's flowing to, we see that the largest issuer is, in terms of geography, is South Africa, and that's not surprising because they have a very sophisticated market. But following not very closely after that is Nigeria and Mauritius, as well as other markets like Morocco. But that is not to say that other markets are not raising capital as well. As FSD Africa, we've supported 2 issuances recently in Tanzania that are currently in market, and they're seeking to raise $45 million US. So that's one part of the answer. The second part of the answer, we can look at data on private capital, and this is where capital is raised through investment instruments that are not traded on the exchange. So when we look at the data from last year, we find that most of the capital has been raised and channeled through investment deals in West Africa. 31% of the private capital has been directed towards deals there. And when you look at the actual market, you'll see it's Nigeria. But beyond West Africa, we find that South Africa has been able to attract about 19%, East and Northern Africa, 18%. But if you drill further to look at which sectors are receiving these funds, you'll see it's the financial services sector. And then you look at where is the capital coming from, where is it flowing from, it's largely international capital that is flowing through these private deals. And so just to say, in closing, I think for us as FSD Africa, we see the role of capital market development in terms of the entire ecosystem to just enable this capital to flow better from where it is held to where it is needed most so that the economies can grow sustainably.
All right, before I let you go now, would you say Smart Money was impressed with most of the pitches they got, at the event? I know that a lot of investors were there looking for where to stack their money. Were they impressed?
I mean, I would imagine that there are opportunities for every kind of investor. So it depends. I mean, different investors have different kinds of capital. So different kinds of investments that are looking for different kinds of capital. I'm sure this is a great opportunity to match those two. And so I would say, I don't know whether I would say impressed, I wouldn't answer for them, but I want to believe that there's an opportunity for investors and investors and those who need the capital to meet where their interests match.
Fantastic. Thank you so much for coming on show, Mary Njuguna, Principal Specialist, Capital Markets, FSD Africa. Thank you so much.
Thank you. Thank you, Ladi.
All right, now let's head on to Europe. See, French President Emmanuel Macron is in Hamburg, Germany, for a second day today, where he and his cabinet's meeting with their German counterparts. While on the surface, it's beer drinking and backslapping, this meeting bellies a power struggle between Europe's 2 biggest powers. Joining me now is Cassandra Sunt, right there in Berlin. Great to have you, Cassandra. So it seems that Paris and Berlin are at odds over a growing number of issues. What economic priorities are topping the list for both sides?
Thanks for having me, Lottie. Yes, there are a growing number of economic issues that are really straining the relationship between France and Germany. There are, of course, growing concerns from both sides about defense programs and policies towards China, but by far the biggest economic issue is energy. On the one hand, you have France, which is one of the most nuclear-powered countries in the world. And on the other hand, you have Germany, who decided to phase out nuclear a decade ago and turned more towards cheap Russian gas. But we all know how that turned out, with the taps to Russian gas being cut off following the full-scale invasion of Ukraine. Now, German industry, which is a major part of the economy here, is struggling. BASF, for example, is a bellwether of German industry, and it's recently been cutting jobs in Europe and investing in China instead. Now, there is a concern in Germany that cheap French electricity is giving the French a competitive edge. Germany and some EU members are pushing for stricter rules on state-backed support of power prices. Berlin and these other officials fear that Paris will offer state-backed fixed price contracts for nuclear power to its national energy champion EDF, and then spend that revenue it raises on supporting French industries. But the French are fairly unsympathetic to Germany's struggles with high gas prices. One French official told Reuters that the Germans have, quote, shot themselves in the foot, and now they want to shoot us in the foot to get even.
Quite interesting. Well, there seems to be a chemistry problem here that's making business difficult. Give us a backstory. How did this start?
Well, from my perspective, it does seem like a lot of little slights and disagreements that have really snowballed. One chapter of this was when Germany launched the European Sky Shield air defense system, but they used U.S. and Israeli hardware instead of a Franco-Italian option. That actually prompted Paris to call off a joint Franco-German meeting last year. Then there has been the approach to China, which seems just ever so slightly misaligned between the French and Germans. Berlin is still favoring Wandel durch Handel, or change through trade, but Paris wants a more assertive approach. For example, when Brussels launched a probe into Chinese electric vehicles, France encouraged the move, but Germany had reservations.
All right, let's turn to the markets briefly. What are investors in Europe looking at?
Well, European equities have rebounded on today's opening. They fell yesterday on surging oil prices. Markets also rallied as oil paired gains. London's FTSE 100 index rose 0.9%. The Paris CAC 40 gained 1.2%, and the DAX index jumped 1.3%.
All right, thank you so much. That was Cassandra Sunday giving us details from Europe. Let's move on to Asia now. We'll see Asia-Pacific markets were mixed as investors assess the market impact of the attack on Israel by Palestinian militant group Hamas. Japan's Nikkei 225 there. We'll see it's up 2.43%, 31,746 points. But the Kospi is in red, closed in the red, 0.26%. Down. HSI index 17,664 points, up 0.84%. Other markets we track in Asia there, Shanghai 0.70% down, and the ASX 200 in Australia 7,040 points, 1.01% up. Let's take it on to the U.S. now. We've got to check on those markets. The U.S. stock futures were slightly higher today, boosted by a drop in Treasury yields as Wall Street assessed the impact and risk of the protracted conflict from Israel and Hamas war. If you look behind me there, we see it's green for the futures. Dow Jones Industrial Average futures 0.21% up, 33,871 points. For the S&P 500 futures is up 0.18% at 4,376 points. And the tech-heavy NASDAQ sits at 15,221 points, up 0.23%. We see PepsiCo shares rose by 1.5%. And the pre-market of the snack retailer reported better than expected third-quarter results. The company also raised its earnings outlook. All right, we'll take a break now. When we come back, commodities market update is next. Do stay with us. Welcome back for the commodities market update. Now let's look at the poultry market. Price of a crate of egg has increased by 40% from 2,000 naira to 2,800 naira. Let's find out the drivers now. Let's talk to Fumi Adibowale, manager, financial derivatives company. Great to have you on the show.
Afternoon. Thank you for having me.
Fantastic. So what would you say is responsible for this price hike, and what impact will it have on food inflation, which is currently at 29.34%?
Yeah, so actually the price of eggs usually fluctuates. I know, and the peak period is usually between September to December. So what happens during this period that there is always increased demand. First of all, there's increased demand for consumption by children. During in September, schools are in session, and we see increased demand for consumption purposes. We also see that in Q4, which is towards the end of the year, there is increased celebration, weddings, birthdays, and because of these, bakers and other confectioners demand for this commodity. And when there is increased demand, what happens is that price will increase. But more importantly, I think farmers are currently battling with high cost of feeds, and that's because of the spike in the price of maize. Maize accounts for over 50% of poultry feed. So an increase in price of maize is translating into increased price of eggs. And what this means is that there's going to food inflation will definitely increase, because egg is one of the items in the food basket. But the magnitude of increase depends on the weight of eggs in the basket.
And definitely there's a correlation between income levels and protein consumption. Right now, we know consumers are squeezed from all sides. What are you seeing for egg consumption in Nigeria going forward, and how will it affect productivity and growth?
Of a truth, there is a positive correlation between income levels and consumption generally, and not just protein. What happens is when your income increases, you tend to increase consumption, and vice versa, meaning that when income level drops, you reduce consumption. And currently, an average Nigerian is actually battling with squeezed income, meaning that we are forced to reduce the amount of produce of any product or any commodity you buy. So consumers are actually left with two options. You have a budget constraint, meaning that your nominal income is the same while your real income is falling. So one of the options is for you to reduce the amount of this commodity that you consume, meaning that your indifference curve will shift downwards. The utility you get from the product will increase. The other option is for you to probably get a loan and stay on the same indifference curve. But I think the most probable option is to reduce consumption, and that is happening currently. We are seeing the demand for eggs decline because people can no longer afford what they used to. So what 3,000 naira worth of egg in 2020 is not the same thing with the same. It is not the same thing you'll be able to buy in 2022. So definitely, demand for egg will reduce.
Right, and I do not want to take a loan to eat. That's the terrible investment. But we've seen the cost of feeds and other poultry industry inputs like vet medicine, they've increased recently. If this continues, what is the viability of egg production in the country?
Like I mentioned earlier, that one of the factors that is making farmers increase the price of eggs is because of the spike in the price of maize, one of the major inputs for poultry feeds. But maize is not the only thing affected. There are other inputs that have been affected: cost of medicine and all. More importantly, even the cost of logistics, moving the inputs down from where it's being produced to the market point or to where the farmers are is high. Then after the farmers are done producing the eggs, the cost of moving it from the farm gate to the market is also high. So all these factors are actually coming into play. And more importantly, we're also seeing, because of the high cost of inputs, some farmers that cannot cope are actually shutting down operations. So meaning that if the price of egg is lower than the average cost of production, definitely you have to shut down. And it means the market is based on survival of the fittest. So if you cannot cope, you're out of the market. And if this trend actually continues, it means that the production of egg would decline further, and that has significant implications for individuals and even for the country as a whole. Currently, I think egg consumption per person in a year is about 78 eggs in Nigeria currently, compared to the US, where the average consumption is about 285 eggs per annum, and even South Africa, where consumption is about 128 eggs per annum.
And recently, we know South Africa, the second largest egg-producing country in sub-Saharan Africa, is currently experiencing an outbreak of bird flu, leading to a shortage of eggs and poultry. What's the possibility of the disease spreading to Nigeria? Very briefly now.
Yes, so currently, Nigeria's domestic production is not sufficient to meet demand, and the country has been importing eggs. And South Africa was one of the countries where Nigeria imported from in 2021. About 13% of total egg imports was from South Africa. So if this trend continues, it means that if we eventually import eggs that are infected, then the chances of this disease spreading to Nigeria is high. But if the other markets where Nigeria can turn to, then I think the risk of disease spreading to Nigeria is actually low.
Fantastic. I guess we need to protect the birds going forward. Thank you so much, Fumi Adebowale, Manager, Financial Derivatives Company. Thank you. All right, let's move on to other stories now. The International Monetary Fund has downgraded Nigeria's economic growth by 0.3 percentage points to 2.9% for 2023, following weaker oil and gas production. Meanwhile, in its update baseline forecast for global growth, the report shows that the global economy will slow from 3.5% in 2022 to 3.0% in 2023 and 2.9% in 2024, well below the historical average of 3.8%. Advanced economies are expected to slow from 2.6% in 2022 to 1.5% in 2023 and 1.4% in 2024 as policy tightening starts to bite. Take a listen.
A number of regions in the world have seen a huge increase, in particular in the headline part of the price index coming from the energy and in some countries food prices as well. Now, does that mean that there is no role for monetary policy? And the answer is no. Why? Well, because these shocks to headline inflation tend to feed into broader measures of inflation. They first hit your energy bill, but then energy bill is, part of the production costs for businesses. It's part of the living expenses for workers. So then it leads to higher demand for wages. It leads to higher prices for businesses. Then it gets into underlying measures of inflation. And what is really important for monetary policy is to make sure that the underlying measures of inflation are going to be coming down. And if this is not contained, then it gets into measures of expectations of inflation. You see inflation high for a while, then you come to expect inflation to be high for a while, and then it becomes almost self-sustaining. So monetary policy has a role to play in order to make sure that both inflation expectations and underlying measures of inflation are contained, even if the source of the shock, as you rightly pointed out, could be on the energy side. And this is why our recommendation for monetary central banks around the world, in the face of a fairly persistent energy price shock, is that they needed to tighten monetary policy. And this is showing its effects already in the world economy. It's been cooling off global output for sure, but it's also showing signs that it's helping bringing down inflation, bringing it back down to central bank.
Still in North Africa, Egypt's annual urban consumer price inflation rose to a historic high of 38.0% in September, climbing from 37.4% in August and topping analysts' expectations. As according to data from the age statistics agency CapMass, it was the fourth consecutive month of record highs recorded on the central bank website, which is figures going back to 2000. The median forecast of 18 analysts polled this week had shown annual urban consumer inflation rising to 37.6% in September. The previous high before inflation soared in June was 32.95% recorded in July 2017. Inflation also accelerated on a monthly basis, with prices rising by 2.0% compared with a 1.6% increase in August. And now to Kenya. You see, fintech startup Secondtax has added the Nigerian Stock Exchange to its platform, giving investors in Kenya a chance to invest in the Nigerian local bourse there directly with a 7 trillion Kenyan shilling market. The Ghana-based firm launched in the Kenya market last November, signing up local stockbroker Castro Capital and Ghanaian intermediary Data Bank. And that's the show today. Thank you so much for watching. I'm Ladi Williams. Remember, you can watch this again on our YouTube channel. Just flip over to YouTube, Central Channels Television. You can watch all our production. Thank you again for watching. I'm Ladi Williams. Bye for now.